this video probably sucks. It's probably boring for you, but if you pay attention and you take some good notes, you're going to piss off a lot of people at the bank. Chase and Bank of America is going to be calling you, asking you, why'd you do this? Because you're going to have robbed them from $150,000 worth of interest and paid off your loan almost 5 years faster. So if you want to save money and you want to get your mortgage paid off quicker, make sure you pay attention to this. Take some notes and comment below what you're going to do with all the savings. Let's get into it. The banks love that you're going to Starbies every day. They absolutely love it. Why? Because you're putting it on that Amex card. So they're getting to charge your Amex card. They're making interest on what you on that $10, and you're not able to pay the loans that you have against them any faster. So today we're going to be talking about how you're going to be able to pay off your mortgage, save years, and save almost $150,000 by just cutting out Starbies or whatever fast food you're spending. Now, the average American is probably spending anywhere between $500 to $1,000 a month. I've even seen people spending $2,000 to $3,000 a month on fast food every single month. It is absolutely bonkers how irresponsible we become with money. People are choosing to live above their means, and so savings are depleting and the banks are just raking in the interest. So let me give you an example, and you're going to want to pay attention to this. Get your notebook out. For a $600,000 purchase, if you did an FHA loan at 6% rate, which is very common right now, we're shooting this at the end of 2024. At a 6% rate, you're going to be paying almost $1.2 million in payments over a 30-year span. Now, if your loan amount was only $579,000, like how is that possible that you're paying more than double in just interest? That is fucking insanity. But yet we do this, right? And so like we're more inclined to take that short hit of caffeine and sugar than to like prep ourselves to pay off our mortgage earlier and really save hundreds of thousands on interest. Like you can literally buy a Tesla truck with how much you're going to save in interest if you just follow the steps in this video. Now, I know what you're thinking, like, dude, I love my Starbies. Like, no way am I going to give up a hot white chocolate mocha. But like you can replace it by just watching more of this white chocolate. Make sure you follow and subscribe for more content like this. All right, back to this video. So today we're going to analyze how much you could save if you just pay an extra $10 a day towards your mortgage. That's $300 a month. And I get it for all you people out there that are like, February only has 28 days. But like we're going to offset it with the extra months that have 31. So let's take 30-day averages, $300 a month towards your principal. Now, when you're making your payment, there's going to be a box that you're going to want to check that says pay these extra $300 towards my principal and not towards my interest. Because if you don't check that box, they're going to apply that towards the interest. And trust me, the bank mafia, they're the biggest mafia. They're the strongest mafia. They want to take that extra money and just keep it for themselves. So protect yourself, check the little box and double check it yourself. So I just said you're going to pay almost $1.2 million in total payments if you do a $600,000 purchase with 3.5% down at a 6% rate. So before I get into like how much you're actually going to save and why you're going to save it, let's talk about what makes up a mortgage payment, because I want to be clear, right? You're only going to be addressing principal and interest. So those are the first two components that make up a payment. The third component is taxes. Your taxes are probably going to go up over time. So when people are calling me like, dude, Tony, my mortgage payment went up. If you have a 30-year fixed rate, your principal and interest does not change. It's your taxes or your homeowner's insurance, which is the fourth component, that is going to go up. Homeowner's insurance is atrocious right now. Everyone hates insurance companies. That's because they're having to pay out money, right? You just had like natural disasters everywhere. And Kamala's only trying to give $750 to the people who survived the hurricane. It's bonkers, but that's neither here nor there. Now, the fifth component is mortgage insurance. In this video, we're specifically talking about an FHA loan, but you can use this for an FHA or conventional loan and a conventional loan that doesn't have 20% down. So now what are you going to do, right? So if you're spending $10 a day on Starbies or McDonald's or Dunkin' Donuts, whatever you're like, or it could be OnlyFans, right? Like, I don't know what you do at night when you're in the bathroom by yourself. But what I want you to do is I want you to take those $10 and put those into a savings account. Like that's even better because the money while you're saving it and prepping it for your mortgage is going to make you a little bit of extra money. When you go make that mortgage payment, you're going to take those $10 a day, which should be about $300 for the total month. and you're going to apply it towards your principal. Now let's calculate how the lender calculates principal and interest. What we're going to do is we're going to take 600,000. We're going to subtract out the 3.5% for the down payment, which is 21,000. And then because I love FHA loans, we're going to add on the mortgage insurance premium of 1.75%. Now you're going to take that figure, multiply it by 6%, and that's going to give you the yearly average of 35,000. That's going to give you the yearly interest that they're going to collect of $35,347. Now you're going to divide that number by 12, and that's how much interest they're going to collect on their first payment. Now the way amortization schedules work, or mortgage payments work, is after every payment, they're going to take that amount that you actually paid towards principal, right? Which what's going to be left over, you take the number for principal and interest, subtract out what we just calculated for interest, and that's how much goes towards principal. I'm not smart enough to know how they calculate the principal portion of it. Maybe one day I will, but not today. So now that I've bored you with how they calculated principal and interest, we're going to figure out what happens in the amortization schedule. To figure out your next payment, because remember, this is a fixed number, they're going to reduce out how much you pay towards principal, and then they're going to do this whole calculation over again. Now we want this video to be over within the next few minutes, so we're not going to do it for every payment. And so here's a brief example of what an amortization schedule looks like. And what those $300 are going to do is it's going to pay off your mortgage, ready for this, in 24 years and 6 months. That's saving you 5 years and 7 months of total payments. That's almost $150,000 in total savings. So think about that. By you paying an extra $3,600 every single year, or an extra $90,000 into your loan spread out over a 25-year term, you're going to save $150,000 of interest that the bank's not going to be able to take from you and your family. So could you imagine what you could buy with an extra $150,000? It's actually bonkers. Now, of course, the more you pay towards a principal every single month, the faster you're going to be able to pay off this loan. So if you're thinking, hey, what should I do in order to be able to get out of this mortgage debt as fast as possible? It's very simple. Stop going to Starbies. Take those extra $10, put them into a savings account. Do this every single day. And over the next 25 years, you'll pay off your mortgage 5 years ahead of time and save yourself $150,000. Make sure to like and subscribe and comment below what you would buy with $150,000 extra in your pocket.